Welcome back to Revise and Resubmit, and welcome to another weekend book review. I'm Pavlov.
And I'm Nikita.
Imagine you're maybe starting a huge construction project, and someone tells you that a measurement error, just a tiny fraction of an inch right at the start,
Yeah.
could mean the whole skyscraper is miles off course at the top.
Wow. That's quite a thought.
Or picture a simple map. But this map doesn't just show where you are. It can maybe predict where global trade is heading, or even signal, that tiny shift that could tip an economy into crisis.
These aren't just abstract ideas, are they?
No, not at all. They're like these invisible threads weaving through our daily economic lives. They shape everything from, your morning coffee price to national prosperity.
And those very threads are what we're hoping to gently unravel today. This discussion is really an exploration of those foundational ideas.
And we're drawing from a unique perspective, right?
Exactly. It's a large language model-assisted summary of a really insightful book, 21 Equations That Shaped the World Economy.
Ah, yes. That's the one by Professor Panayotis G. Michaelides. He's a full professor at NTUA in Greece, School of Applied Mathematical and Physical Sciences.
And he was also a research associate at the London School of Economics, the LSE, in the UK.
Right. And his intention with the book was really to make these quite complex economic concepts genuinely accessible.
He did a wonderful job. And honestly, as a testament to the depth of his original work, we really do urge you, whether you follow our show regularly or not,
Please do.
make time to read the actual book. It's so thoughtfully crafted.
We've put a link in the show notes, of course. Nice and easy for you.
So our mission today is really to serve as your guides through this rich material. We want to distill the core concepts from each chapter.
And we're especially thinking about you if you happen to be new to academic research, maybe just starting out on your own scholarly journey.
Yeah, we want to show you how these foundational ideas are, they're much more than just formulas on a page.
They're like lenses, aren't they? Lenses to help understand the world.
Precisely. Powerful lenses.
Okay, so let's begin with something that might seem simple on the surface, but holds immense power. The compound interest rate.
Ah, yes, the magic of compounding.
At its heart, it's about how money grows, but not just on your initial investment.
But on the interest it's already earned. That's the key.
It's an exponential force, really.
It is, and it's fascinating. The idea of interest goes way back, ancient civilizations even.
Really?
Oh, yes. But it really found its systematic footing, became what we recognize today in modern finance, largely thanks to the medieval Italian city-states.
Ah, the early bankers.
Exactly. Their innovative practices laid crucial groundwork. It fundamentally changed how we perceive the value of money over time.
So the equation itself, it's quite elegant. A equals P, 1 plus R and N, raised to the power of NT.
Let's break that down a bit.
Okay, A is your final amount, what you end up with. P is the principal, your starting sum.
Got it.
R is the annual interest rate. Tells you how many times that interest is compounded each year. Is it annual, semi-annual, monthly?
Wait, T is just the number of years.
Right. So, quick example.
Yeah.
Say you invest $1,000 at 5% for 3 years. With simple interest, just interest on the principal,
Yeah.
you get $1,150.
Okay, straightforward.
But with compound interest, even if it's just compounded once a year, you end up with $1,157.63.
So about $7.50 more. Doesn't sound huge initially.
Exactly. That $7.63 might seem small, but scale that up. Across vast sums over longer periods, it becomes truly immense.
And that's crucial for you as a new researcher to grasp that exponential power.
It's not just personal finance stuff.
No, far from it. It's fundamental to understanding why maybe small differences in initial conditions or subtle policy shifts can lead to vastly different long-term economic outcomes.
So it's vital for, scenario planning.
Indispensable for rigorous scenario planning and forecasting in your own research, absolutely. It highlights risk versus reward too, amplifying both potential returns and losses.
But like all models, it has its nuances, right? Simple interest still pops up.
It does in very specific contexts. But looking at how compound interest evolved, it tells a deeper story.
About how we think about money's value.
Exactly. How human thought shifted from simple calculations to understanding this powerful compounding force that now underpins so much of finance.
Okay, from the growth of money, let's shift gears. How are economic things distributed? Let's talk about the normal distribution.
Ah, the bell curve. Everyone recognizes that shape.
Right. Its core idea is that many economic variables, things like incomes, maybe stock returns, even people's heights.
They tend to cluster symmetrically around an average value.
It's amazing how often this pattern appears. And its roots are deep, aren't they? Back in the Enlightenment.
That's right. Formalized by mathematicians like the great Carl Friedrich Gauss, he was actually using it for astronomical observations initially.
From stars to stocks, that's quite a leap.
It is. The equation itself describes that bell shape. You have x for the variable, for the mean or average, for the variance.
Variance tells you how spread out the data is, right?
Precisely, and is just the base of the natural logarithm. We also often use z-scores, which standardize the data, making comparisons easier.
And then there's that famous rule, 68-95.
The 68-95-99.7 rule. Roughly 68% of the data falls within one standard deviation of the mean, 95% within two, and nearly all, 99.7%, within three.
It's a really neat way to quantify how spread out things are.
It is a powerful way to understand how concentrated data is around its average.
So for you as a researcher just starting out, the normal distribution is like an essential lens. It helps you understand variation in your data.
Absolutely. It empowers you to build more robust models, to test hypotheses effectively.
And critically evaluate whether patterns you see are genuinely significant or maybe just random noise.
Exactly. It's often a foundational step before you can draw any really solid conclusions from empirical work.
But like any model, it comes with caveats.
Always. It assumes symmetry, a sort of fragile equilibrium, but real-world economic data. It often deviates.
Especially during extreme events, I imagine. Black swans?
Precisely. Extreme events, nonlinearity, even human behavioral biases can lead to distributions that look quite different, skewed, or with fat tails.
Meaning more extreme events than the normal curve would predict.
Right. Which means researchers often need to look at alternative distributions to get a more accurate picture of reality.
Okay, understanding the spread is one thing. But what if you want to understand the relationship between different data points?
Now you're leading us towards ordinary least squares, or OLS.
Right. This is a really fundamental statistical method, isn't it?
It really is. It helps us estimate relationships between variables. The basic idea is to draw a best fit line through your data points.
And best fit means minimizing the distance. Or rather, the squared distance.
Exactly. Minimizing the sum of the squared differences between your actual observed values and the values predicted by that line.
Where did this come from? Also astronomy.
Historically, yes. Astronomers and mathematicians like Gauss, again, and Legendre used it for fitting curves to observational data.
Fascinating.
It then became absolutely crucial in econometrics in the 20th century, a real workhorse for empirical analysis.
So let's picture it. Maybe plot worker hours versus units produced. The basic equation is y equals 0 plus all 1x1 plus x.
Let's unpack that. Y is your dependent variable, what you're trying to explain, like units produced.
Okay. And x1 is your independent variable, what you think influences y, like worker hours.
Right. X is the intercept where the line hits the vertical axis, and 3,1 is the slope.
The slope is key, right?
Right.
It tells you how much y changes for a 1 unit change in x1.
Exactly. So if OLS tells you GRU1 is 2.1, it means each extra hour worked is associated with producing 2.1 more units, according to your model.
And that little et at the end.
That's the error term. It captures everything else that influences y, but isn't included in your x variable, the unexplained part.
And then there's r squared, r. That tells you how well a line fits.
Yes, r squared gives you the proportion of the variation in y that's explained by your x variable, a measure of model fit.
So for you, the new researcher, OLS is, well, pretty indispensable.
Oh, absolutely. It's a workhorse for analyzing data, testing policy effectiveness, forecasting trends, building empirical models.
It helps you quantify those connections between economic variables.
It forms the bedrock of so many quantitative studies. You really need to understand it well.
But again, important to know its boundaries.
Always.
No.
OLS relies on certain assumptions, like the error terms, the ACE being normally distributed ideally.
And it might not capture situations where y influences x too, like a feedback loop.
Right. It struggles with bidirectional causality sometimes. Or if there are crucial factors you haven't measured, omitted variables that can bias your results.
So researchers sometimes use other techniques.
Yes. Things like maximum likelihood estimation or the Bayesian methods might be used. And it's always crucial to consider the broader socioeconomic context, not just the statistical correlation.
Okay, from data relationships, let's pivot. Let's talk about the very engine of an economy, the production function and total factor productivity, TFP.
Right. So at its core, this is a mathematical way to show how inputs get transformed into outputs.
Inputs like labor, capital.
Labor, capital, like machinery, buildings, and crucially, technology. And the output is the goods and services the economy produces.
This sounds like a pretty foundational idea. Where did it come from?
Well, the historical context is quite rich. You can trace ideas back to Adam Smith and his thoughts on the division of labor.
And John Stuart Mill on diminishing returns.
Exactly. It got formalized more mathematically in the neoclassical era, Marshall, Pareto, Walras, then popularized by the Chicago School.
Yeah, Robert Sala's big contribution was.
He was groundbreaking because he explicitly integrated technological progress into the model, showed how important it was for growth.
The most common form you see is the Cobb-Douglas function, right?
Right.
Y is A like Co.
That's the one. Y is output. A represents the level of technology. Think of it as efficiency.
Okay. L is labor, K is capital. And those Greek letters, A, I, and B.
Alpha and beta are the output elasticities. They tell you how much output changes percentage-wise if you increase labor or capital by 1%.
And what about TFP? Total factor productivity.
TFP is often called the Solow residual. It's basically captured by that A term. It represents efficiency gains and innovation beyond just adding more L or K.
Like the secret sauce. Doing more with the same inputs.
Kind of. It captures that unexplained growth. And if I++ happens to equal 1, it implies constant returns to scale.
Meaning if you double all your inputs, you double your output.
Exactly. And these elasticities also have implications for how income gets distributed between labor and capital.
Let's try an example. If A2, L10, K5, and Baga and Anuit Hall are both 0.5.
Okay, plugging that in. Y would equal 2 times the square root of 10 times the square root of 5, which gives you an output Y of roughly 14.110. TFP, that A factor, really boosts things.
So for a new researcher, this production function idea is incredibly insightful.
Definitely. It helps businesses think about optimizing production, guides policymakers in designing growth strategies.
It really highlights how innovation boosts overall output. It's fundamental to understanding economic prosperity.
But as always, there are simplifying assumptions.
Like constant returns to scale might not always hold.
Right. Or the assumption of Hicks-neutral technological change, which is a specific way technology improves things. Reality can be messier.
It also tends to aggregate inputs, maybe missing finer details.
Yes, and critics point out it often neglects the historical context or social and environmental dimensions. Many argue for a more holistic, maybe multidisciplinary approach to understanding production and growth.
Okay, now for something a bit more, maybe nuanced, the profit rate.
Right. This isn't just about one company's bottom line. It's more about analyzing the tendencies and fluctuations of profit within the whole economic system.
And how that links to things like instability, income distribution.
Exactly. Its historical roots go back quite far. Classical economists like Adam Smith talked about how competition might drive down profits.
And David Ricardo focused on rent-squeezing profits.
Yes. But the concept was most, perhaps controversially, developed by Karl Marx. He looked at profit rates through the lens of what he saw as capitalism's internal contradictions.
How?
He argued that firms, driven by intense competition, would initially boost production. This might lead to higher wages, which then squeezes profits.
Okay.
And that profit squeeze, in turn, would drive firms towards mechanization, substituting capital, machines, for labor to cut costs.
That sounds oddly familiar today, with discussions around AI and automation.
It does, doesn't it? The dynamic he described has echoes.
So there isn't one single neat formula for the profit rate itself presented here.
No, it's more about understanding the cyclical dynamic. Firms chase profit, production expands, wages might rise, profits get squeezed, leading to more mechanization.
And for you, the new researcher, what's the takeaway?
It offers insights into how economies function, where potential vulnerabilities might lie, how systems evolve. It connects directly to big debates about income distribution, technological change, economic stability.
Informing policy discussions on things like wealth inequality or worker protections.
Precisely.
But there are critiques of this view too.
Oh, certainly. It often relies on that ceteris paribus assumption, all else being equal.
Which it rarely is in the real world.
Exactly. There's also a specific assumption that technological progress always increases the capital intensity of production, which might not be universally true.
Maybe it focuses too much on internal factors.
Some argue it can over-focus on internal contradictions, potentially neglecting crucial global interdependencies or specific historical contexts. It's best seen as an analytical framework for understanding system tendencies, not an iron law.
Okay, From the dynamics within industries, let's broaden our view considerably. Let's talk about general equilibrium, or GE.
Right. This is a big one. The core idea is ambitious. How can all markets across an entire economy reach a state of simultaneous balance?
Where supply equals demand everywhere at the same time.
Oh, exactly. It was a revolutionary idea really pioneered by Leon Wallace back in the late 19th century.
That's a major shift, isn't it? From looking at one market in isolation
to viewing the whole economy as an integrated, interconnected system.
Yes.
It was later formalized with much more mathematical rigor by Arrow and Debreu in the 20th century.
They actually proved such an equilibrium could exist.
Under specific and quite restrictive conditions, yes. Their work provided proofs for existence and uniqueness.
So this Walrasian equilibrium, it focuses on consumers maximizing their happiness, their utility.
Subject to their budget constraints, yes. And crucially, all markets must clear total demand equals the total supply or endowment for every single good.
And there's this idea of a Walrasian auctioneer, sort of guiding prices.
It's a conceptual device. An imaginary auctioneer calls out prices, agents calculate their demands and supplies, and prices adjust until everything balances. It's a way to think about how equilibrium might be reached.
And in this ideal state, firms make zero economic profit.
Under the assumptions of perfect competition, yes. Any potential profit attracts new entrants, driving the price down until only normal returns remain.
So imagine you have Agent A and Agent B trading goods. GE shows how their individual choices can align across all markets simultaneously.
That's the goal. A complete, consistent picture of the entire economy in balance.
Now, for you as a new researcher, GE offers a genuinely, well, holistic view.
It really does. It helps understand market interdependencies, how a change in one market can ripple through the entire system.
So it's valuable for policymakers thinking about the broad effects of, say, a new tax or a technological breakthrough.
Incredibly valuable conceptually, yes. Helping trace those ripple effects is a key insight.
But it rests on some pretty strong assumptions, doesn't it?
Extremely strong. Perfect information, perfectly rational actors, zero firm profits, that atonement or trial and error adjustment process.
Which don't really reflect the real world perfectly.
Not closely, no. Critics point out that early models even struggled to guarantee a unique equilibrium. And the framework can vastly oversimplify the complexities of real economies where markets are imperfect and information is often incomplete or asymmetric.
Okay, so if general equilibrium is about how markets could balance, what about mapping how they actually connect?
That leads us nicely to input-output I/O analysis. This framework focuses on the detailed interdependencies between industries.
Like a map of the economy's plumbing.
That's a good analogy. It captures the flow of goods and services between different sectors, usually presented in a matrix format.
Who came up with this?
This was a work of Wassily Leontief. He felt economics needed to move beyond isolated market analysis towards a more comprehensive, interconnected view. He wanted to see the actual structure of production.
And the core is the Leontief equation. X equals AX plus Y.
Right, which rearranges to X because IA, inverse times Y. Let's break that down.
Okay. Y is the final demand vector, what consumers, government, exports ultimately want.
Correct. A is the crucial matrix of technical coefficients. It shows how much input sector I needs from sector J to produce 1 unit of output.
So how much steel the car industry needs per car, for example.
Exactly. And X is the total output vector for all sectors needed to satisfy that final demand Y.
What about that IA inverse part?
That's the Leontief inverse matrix. It's incredibly powerful because it captures the full ripple effect, not just the direct inputs, but the inputs needed to make those inputs, and so on down the entire supply chain.
So if car demand surges, I/O analysis tracks the impact on steel, rubber, glass, energy, everything.
Precisely. It shows the total impact, direct and indirect.
So for you, the researcher, this is invaluable for
illuminating those indirect and induced effects. It's crucial for policy analysis, estimating the impact of infrastructure projects, for instance.
Understanding disaster recovery needs, mapping supply chains.
Yes, all of that. Especially important today for understanding complex global supply chain dynamics and vulnerabilities.
But like any tool, it has its limits.
Of course. It typically assumes constant technical coefficients over the period studied, meaning technology doesn't change rapidly.
And linear relationships.
Yes, assumes linear relationships, which might not hold if there are economies of scale. It's also inherently static in its basic form, a snapshot in time.
And treating whole sectors as uniform can be an oversimplification too.
It can, yes. It often treats sectors as homogeneous, masking internal diversity. So it's powerful, but needs careful application.
Okay, let's shift scale again. From the whole economy down to a single firm's decision, let's talk about the break-even point, BEP.
A really fundamental concept for any business.
It's simply the level of sales where your total costs exactly equal your total revenue, right?
Exactly. Zero profit, zero loss. The point where you break even. It's a crucial tool for financial planning and managing risk.
Has this idea been around long?
The underlying concept, sure, but it evolved into an explicit, really crucial tool for businesses, especially useful in times of economic uncertainty. It gives a clear target.
And the equation is wonderfully simple. BEP in units, fixed cost divided by selling price per unit minus variable cost per unit.
Let's define those terms. Fixed costs, FTC, are costs that don't change with output, like rent.
Okay. Variable cost per unit, VCU, change directly with each unit made like raw materials.
Right. And selling price per unit, SPU, is just what you sell it for.
So that, SPU, VCU, is the contribution margin per unit. How much each sale contributes towards covering fixed costs and then profit.
Precisely. So if a firm has $1,000 in fixed costs, sells widgets for $10, and each costs $5 in variable costs.
The contribution margin is $5. So $1,000 divided by $5, that's 200 units.
Exactly. You need to sell 200 units just to cover all your costs. Unit 201 starts generating profit.
For you, the new researcher, this is vital for understanding firm strategy.
Absolutely. It helps businesses assess risk, set achievable sales targets, optimize pricing, manage resources efficiently.
And it's applicable everywhere, isn't it? Software, event planning, manufacturing.
Incredibly versatile due to its simplicity.
But there are nuances again. It assumes linear relationship.
Yes, it assumes costs and revenues change linearly with output, which might not hold true, especially at large scales. Discounts, overtime, etc. can complicate things.
And insights from behavioral economics might suggest other factors matter too.
Right. Human biases, market dynamics, competitor reactions, they're often more complex than this simple model captures. And it usually doesn't account for social or environmental costs, the externalities.
So a useful starting point, but part of a bigger picture.
Exactly. A valuable tool in the toolkit.
Okay, from a firm's threshold, let's consider a force affecting everyone. Inflation. And the Fisher equation.
Irving Fisher. This equation is elegant in its simplicity and importance.
Its core idea is bridging the gap between nominal interest rates
the rate you see advertised, written down,
and real interest rates,
which reflect your actual change in purchasing power after accounting for inflation.
Fisher developed this in a pretty chaotic time, didn't he? Post-World War I.
He did. He was trying to understand fundamental economic drivers, looking beyond the standard theories of his day, drawing inspiration from various fields.
The approximate equation is really intuitive. Nominal rate, real rate, plus expected inflation.
Or, a bit more precisely, 1 plus nominal rate equals 1 plus real rate times 1 plus expected inflation.
Let's try an example. An entrepreneur takes an 8% nominal loan, but they expect inflation to be 3%.
Okay. Using the more precise formula, 1 plus 0.08 equals 1 plus real rate, 1 plus 0.03. You solve for the real rate.
And it comes out to about 4.85%.
Exactly. The real cost of borrowing, in terms of purchasing power, is significantly lower than the nominal 8% suggests.
That really clarifies things. It shows how inflation erodes returns or reduces borrowing costs in real terms.
And for you, the researcher, this is absolutely crucial for understanding monetary policy.
Central banks use this concept when setting interest rates.
Constantly. It guides lending and borrowing decisions across the whole economy. And it powerfully highlights how inflation can silently eat away at purchasing power, a key macro concept.
But it relies on some assumptions, like knowing future inflation.
That's a big one. It assumes individuals have perfect foresight about future inflation, which is, well, rarely true, especially in volatile times.
And it often uses a risk-free real rate, simplifying things.
Yes, it simplifies the complexities of real financial markets where risk is pervasive. So it's a powerful conceptual tool, but offers a simplified snapshot. It invites more complex analysis.
Okay, building on value over time, let's look at investment decisions with net present value. NPV.
A truly pivotal metric for evaluating investments.
The core idea is to figure out the present value of all the future cash flows an investment is expected to generate.
And then subtract the initial cost of the investment.
Right. It's rooted in that fundamental idea of the time value of money. A dollar today is worth more than a dollar tomorrow.
Precisely. And NPV became deeply integrated into economic analysis and policy decisions throughout the 20th century. Its practical utility is immense.
The equation looks like NPV is the sum of CT1 plus RT minus I0.
Let's break it down. CT is the net cash flow expected in each future time period, P.
So cash coming in minus cash going out for that period.
Right. R is the discount rate. This reflects the opportunity cost of capital, what you could earn elsewhere, and the riskiness of the investment.
Higher risk means a higher R, discounting future cash flows more heavily.
Exactly. T is the time period, and IR is your initial investment cost, right now at time 0.
Let's try a simple scenario. A bakery invests $1,000, IR. They expect cash flows of $300, $400, $500 over the next 3 years. C1, C2, C3. The discount rate R is 5%.
Okay, so you discount each of those future cash flows back to their present value using the 5% rate, sum them up, and subtract the initial $1,000.
And in this case, the NPV works out to about $80.44.
And because that NPV is positive,
the investment is generally considered economically viable. It's expected to generate more value than it costs in today's terms.
So for you, the researcher, NPV is indispensable. It helps firms, policymakers, investors make strategic choices.
Capital budgeting, project evaluation, mergers and acquisitions.
All rely heavily on NPV or related discounted cash flow techniques. A positive NPV is a strong signal, but sensitivity analysis is crucial.
Meaning, see how the NPV changes if your assumptions about cash flows or the discount rate are slightly off.
Exactly. How robust is that positive result?
But again, limitations. It assumes constant discount rates.
Often, yes. And it's incredibly sensitive to those future cash flow projections, which are inherently uncertain.
Critics also mentioned a potential bias towards short-term gains.
Yes, because future cash flows get discounted more heavily. This might lead to neglecting projects with long-term payoffs but lower near-term returns.
And it might overlook qualitative factors, long-term sustainability, community impact.
It can, yes. It's primarily a financial metric. It doesn't easily capture broader impacts on employment, inequality, or the environment. It needs to be used alongside other considerations.
Okay, from investment rules, let's step into the world of strategic games with the Nash equilibrium.
Ah, John Nash. A brilliant concept that really changed economics.
The core idea is a set of strategies, one for each player in a game,
such that no single player can improve their own outcome by unilaterally changing their strategy, assuming everyone else sticks to theirs.
It's a point of stability, in a way, where nobody has an incentive to deviate on their own.
Exactly. It revolutionized economics by moving beyond just perfect competition to analyze situations with strategic interaction, bargaining, even conflict. It brought a more behavioral perspective.
The formal definition looks a bit intense.
Yeah.
FIC.
Let's decode that. Phi is player I's payoff or utility. S is the equilibrium set of strategies, one strategy for each player.
Okay.
I's is an alternative strategy player I could choose. S represents the strategies of all other players in the equilibrium set, S.
So it's saying player I's payoff from their equilibrium strategy is at least as good as their payoff from any other strategy.
Yeah.
SI, given that everyone else keeps playing their equilibrium strategies.
Precisely. No incentive to change alone. The classic illustration is the prisoner's dilemma.
Right, where two suspects are questioned separately.
If both deny, they get a light sentence. If one confesses and the other denies, the confessor goes free, the denier gets a heavy sentence. If both confess, they both get a medium sentence.
And the Nash equilibrium is?
Both confessing. Because if you're one prisoner, assuming the other confesses, you're better off confessing too, medium versus heavy sentence. And if you assume the other denies, you're still better off confessing, go free versus light sentence.
Even though both denying would be collectively better.
Exactly. It shows how individually rational choices can lead to a collectively suboptimal outcome. Fascinating.
So for you, the new researcher, this is a really powerful tool.
Incredibly powerful for dissecting outcomes in competitive scenarios, market competition, auctions, cartel behavior, international negotiations.
It highlights that tension between self-interest and collective well-being.
A theme that recurs constantly in economics and social science.
But it relies on strong assumptions too, doesn't it? Complete information. Perfect rationality.
Yes, those are the standard assumptions, and they often don't hold in the real world. People aren't always perfectly rational. Information is rarely complete.
It can also get computationally very complex with many players or strategies.
It can. And these limitations, in part, led to the whole field of behavioral economics, which tries to incorporate psychological biases into economic models.
Okay, from strategic games, let's turn to valuing financial assets with the capital asset pricing model, CAPM, pronounced CAPM.
Right, a cornerstone of modern finance theory.
Its core idea is to explain the relationship between an asset's systematic risk, the risk you can't diversify away, and its expected return.
And it links us directly to the concept of beta.
Where did KPM come from?
It grew out of Harry Markowitz's work on portfolio theory in the 1950s, the idea that diversification reduces risk. CPM was refined in the 1960s, introducing beta as the key measure of systematic risk.
It was a move towards more quantitative pricing.
Definitely, a response to more ad hoc, less formal methods of assessing expected returns.
The equation itself is EI equal RF plus V, ERM, RF.
Let's break that down. EI is the expected return on the individual asset A.
What you expected to earn.
Right. RF is the risk-free rate. Think of the return on a very safe government bond.
Okay. Beta is the beta of asset I. That's its sensitivity to overall market movements.
Correct. A beta of 1 means the asset moves in line with the market. Greater than 1, more volatile. Less than 1, less volatile.
And that last part, ERM, RF.
That's the market risk premium, the extra return investors expect for taking on the average risk of the overall market, RM, compared to the risk-free rate.
So CPM says the expected return on an asset depends on the risk-free rate, plus a premium based on its own specific market risk, beta, multiplied by the overall market premium.
Exactly. Let's try numbers. If the risk-free rate RS is 3%, the expected market return, ERM, is 10%, so the market risk premium is 7%, and a tech stock has a beta of 1.5.
Its expected return EI would be 3% plus 1.5, 10%, 3% plus 1.5, 7%, plus 10.5% plus 13.5%.
Perfect. The higher beta means investors demand a higher expected return to compensate for the extra systematic risk.
So for you, the researcher, CAPM provides a common language, a framework for thinking about risk and return.
It's essential for portfolio management, asset valuation, corporate finance decisions like capital budgeting, or evaluating mergers.
It also spurred a lot of empirical research, didn't it? Testing the model.
Huge amounts. It really pushed finance towards more rigorous quantitative analysis.
But like all models, challenges remain.
Indeed. CAPM assumes frictionless, efficient markets, rational investors, assumptions often challenged by behavioral finance and observed market anomalies.
It's sensitive to the inputs, too, like estimating beta or the market risk premium.
Very sensitive, and it primarily focuses on systematic risk, struggling with idiosyncratic risk, the risks specific to one company that diversification can reduce.
So its legacy is foundational, but it's constantly debated and refined.
Absolutely, enriched by ongoing debate and the development of alternative models.
Okay, from valuing specific assets, let's zoom out again to the whole economy and money itself with the quantity theory of money, QTM.
A very old and influential theory. Its core idea links the amount of money circulating in an economy to the overall price level.
And maybe economic output, too.
Yes, the connection is often made there, too.
It goes way back, but was really pushed by neoclassical economists, and later, famously, by Milton Friedman.
That's right. Friedman was a key proponent of monetarism, which heavily relies on QTM, but it's also faced significant challenges, particularly from post-Keynesian and Marxist perspectives regarding its assumptions and causality.
The core equation is the equation of exchange. MV equals PT.
Let's define those. M is the money supply.
How much money is out there?
V is the velocity of money, how quickly money changes hands on average.
Okay, P is the overall price level.
And T represents the volume of transactions, or often used as a proxy, real output, like real GDP.
So the total amount of money spent, MV, equals the total value of transactions, PT. That part is almost an identity, right?
It is. The theory comes in with assumptions. Friedman, for instance, argued that V, velocity, and T, real output in the long run, are relatively stable or predictable.
Which imply
that changes in the money supply, M, must primarily lead to changes in the price level, P. More money chasing the same amount of goods means higher prices, inflation.
So the direct link is M influencing P.
And for you, the researcher, the primary implication is its relationship to inflation.
It guides central bank thinking on monetary policy, controlling M to control P.
Historically, very much so. Decisions about contractionary policy, reducing M to fight inflation, or expansionary policy, increasing M to stimulate the economy, potentially risking inflation, are often framed by QTM. Friedman's monetarist rule suggested stable, predictable growth in M.
But there are big debates here. Causality. Does M cause P, or does P, or economic activity driving P, cause M?
That's a huge debate. Does money supply increase first, causing prices to rise? Or does economic activity pick up, creating demand for credit, which then causes the money supply to expand endogenously?
Ah, the endogenous money view. That challenges the idea that central banks fully control M.
Exactly. Post-Keynesian and Marxist critiques often emphasize that money can be created within the system through bank lending based on demand, challenging the assumption of M being purely exogenous, controlled from outside.
QTM also doesn't explicitly handle expectations of future inflation.
Not in its basic form, no. So it's a foundational theory, but one requiring caution and often needing complementary theories for a complete understanding.
Okay, let's step back inside the firm again. Let's look at the cost function.
Right. This is about mathematically expressing the relationship between how much a firm produces, output quantity, and the total costs it incurs to produce that amount.
Seems fundamental for any business.
Absolutely. Roots go back to classical economics Smith. Ricardo touched on costs. Alfred Marshall formalized the distinction between fixed and variable costs.
And then neoclassical economists added more mathematical rigor.
Yes, figures like Samuelson and Arrow really formalized cost functions, linking them tightly to production functions. Now, it's crucial in business management, operations research, data analytics.
The basic linear form is often TCQ, VCQ plus FC. Total cost equals variable cost plus fixed cost.
Or sometimes simplified further as TCQ plus FC.
Where A is the variable cost per unit.
Right, TC is total cost, VC is total variable costs, which depend on quantity Q. FC is fixed costs, independent of Q, and Q is the quantity produced.
So our widget maker again.
Yeah.
$1,800 fixed cost, FC. $15 variable cost per widget, A.
Okay, so to produce 100 widgets, Q100, the total cost TC of 100 plus $1,800, $1,500 plus $1,800 plus $1,800 plus $1,800, $3,300.
And for 300 widgets, TC 300 plus 1,800, 4,500 plus 1,800 equals $6,300.
Exactly. The cost function maps output levels to total costs. It also relates to cost minimization, finding the cheapest way to produce a given level of output, often involving choices between different inputs like labor and capital.
So for you, the researcher, understanding cost functions is key to analyzing firm behavior.
Definitely. It helps firms optimize operations, make pricing decisions, linking to demand, allocate resources efficiently.
Lowering costs can be a major source of competitive advantage.
Huge. Understanding the structure of costs is fundamental.
But the simple linear form is just that simple. Real costs might not be linear.
Often they aren't. There might be economies or diseconomies of scale, learning curve effects, step costs. So more complex functional forms are often needed.
And critics might point to broader factors again.
Yes, the need to consider historical context, social or environmental externalities, costs not captured by the firm's accounts, and advocating for a more holistic, multidisciplinary view beyond just the firm's private financial costs.
Okay, zooming back out to the big picture, long-term economic growth. Let's talk about the Solow growth model.
A really influential framework developed by Robert Solow and Trevor Swan in the 1950s.
Its core idea is to explain long-run economic growth by looking at capital accumulation.
Both physical capital, machines, infrastructure, and human capital, skills, education.
And crucially, exogenous technological progress.
Yes, that was the breakthrough. Solow highlighted that just piling up more capital eventually runs into diminishing returns. Sustained growth in living standards requires technological improvement.
It challenged earlier models that maybe didn't emphasize technology.
Exactly. It put technological progress center stage for long-run growth.
The core of the model is often represented by a differential equation.
Yeah.
KTSFK.
Let's unpack that. K is capital per worker, KL. KOT is the rate of change of capital per worker over time.
Okay. KS is the savings rate, the fraction of income saved and invested.
FK is the production function expressed in per worker terms, YLFKL.
And FA is the depreciation rate, how quickly capital wears out.
So the equation says that the change in capital per worker, K, equals the amount of new investment per worker, SFK, minus the amount of depreciation per worker.
And the model predicts economies converge to a steady state.
Yes, a point K where investment exactly offsets depreciation, SFK. At this point, capital per worker stops changing.
So growth in output per worker stops
Unless there's technological progress, improvement in that A term from the production function, which shifts FK upwards. That's the only source of sustained growth in living standards in the basic model.
Let's try the numerical example. Tech level A1, capital share 0.5, meaning FK, K 0.5, savings rate SK 0.25, depreciation 0.05A.
Okay, in steady state, SFK, so 0.25, KSO 0.05K. Solving that gives you K equals 25.
And output per worker, YSK, 0.5, 0.5 equals to 5.
Right, that's the steady state level without ongoing tech progress.
So for you, the new researcher, Salo provides a foundational framework for thinking about why some nations prosper and others lag.
It guides policy discussions on boosting investment, increasing S, and fostering technological change, increasing A.
And it clearly illustrates diminishing returns to capital alone.
A very important insight.
But limitations exist. It uses a simplified production function.
Often assumes a closed economy, no international trade. And crucially, technological change is exogenous.
Meaning the model doesn't explain where technology comes from, it just assumes it happens.
Exactly. It falls like manna from heaven in the basic model. This led to the development of endogenous growth theories.
Which tried to explain innovation and technological progress within the model.
Precisely. Salo also neglects factors like institutional quality, income distribution, environmental impacts, which are increasingly seen as vital for sustainable growth.
Okay, let's shift to a relationship central to macroeconomic policy debates for decades. The Phillips curve.
Ah, yes, the apparent trade-off between inflation and unemployment.
Its core idea, at least initially, was an inverse relationship. Lower unemployment seemed to correlate with higher inflation, and vice versa, in the short run.
Right. Its emergence coincided with the peak of Keynesian economics influence. Early versions just looked at past data backward-looking.
But it evolved to include expectations.
Yes. Later versions incorporated adaptive expectations. People form expectations based on recent inflation. And the concept of the natural rate of unemployment, NARU, the unemployment rate consistent with stable inflation.
But then the 1970s happened, stagflation.
Exactly. High inflation and high unemployment simultaneously. That severely challenged the idea of a stable, predictable trade-off.
The modern version is often the expectations-augmented Phillips curve. Actual inflation, expected inflation, actual unemployment natural rate, plus...
Let's break it down. Actual inflation depends on what people expect inflation to be.
Plus a term related to the unemployment gap, how far actual unemployment is from the natural rate.
Multiplied by a sensitivity parameter, plus some random supply shocks.
So if expected inflation is 3%, the natural rate is 5%, but actual unemployment falls to 4%, a 1% negative gap.
Then actual inflation might rise above expected inflation. If actual is, say, 0.5, actual inflation might be 3%. F 0.5, F 1% equals 3.5%.
So lower unemployment below the natural rate pushes inflation up relative to expectations.
And for you, the researcher, this is crucial for understanding monetary policy.
Central banks use it, or versions of it, to think about balancing price stability and employment.
They do. It helps frame discussions about labor market dynamics, wage setting, and the potential inflationary consequences of pushing unemployment too low.
But the stagflation experience showed the simple trade-off isn't stable.
It really did. The curve can shift, especially if expectations change or there are significant supply shocks, like oil price hikes.
It's also criticized for maybe not fully accounting for supply-side factors, external shocks.
And the complex ways expectations are actually formed. Are they just adaptive or rational forward-looking?
And the consensus now is that in the long run.
The long-run Phillips curve is vertical at the natural rate of unemployment, meaning there's no permanent trade-off. You can't keep unemployment below the natural rate indefinitely without accelerating inflation. Only a short-run trade-off exists, if at all.
Okay, from domestic trade-offs, let's go global. How do nations interact economically? Let's look at the gravity equation.
A surprisingly powerful and intuitive model for explaining interaction volumes.
Its core idea is that the amount of trade, or investment, or migration between two places depends on their economic size or mass.
And the distance between them. Bigger economies trade more, closer economies trade more.
It's directly inspired by Newtonian physics, isn't it? The law of universal gravitation?
Exactly. Larger masses exert a stronger gravitational pull, and the pull weakens with distance. Jan Tinbergen first formulated it for international trade after WWII.
And it evolved to include more than just geographic distance.
Yes, distance can now include cultural distance, linguistic differences, institutional barriers, lack of a common border, etc.
The simple form is like TJ, massy mass, distance K.
Right. TAJ is trade volume between I and J. My and MJ are their economic masses, often GDP. Day is the distance. G is just a constant.
And the extended versions add other factors.
Yes, you might see terms added to account for things like cultural similarity, C, common language, L, institutional compatibility, I, trade agreements, etc., often modifying the distance or mass terms.
What's amazing is how well this simple physics analogy actually works in explaining real-world trade patterns.
It's remarkably robust empirically, one of the most successful empirical models in economics.
So for you, the researcher, this is fundamental in international economics.
Absolutely. Explaining trade flows, foreign direct investment patterns, migration flows, understanding global value chains, regional economic clustering.
It provides a baseline expectation for interaction levels.
But limitations. It often suffers from omitted variable bias.
Things not explicitly included, like geopolitics, specific tech changes, policy intervention.
Exactly. It also typically assumes countries or regions are homogeneous internally, overlooking disparities.
And traditional versions are static, don't capture dynamic changes easily.
Right. They struggle with evolving relationships over time, so it's powerful but needs careful specification and often complementary models for a full picture.
Okay, now for a statistical concept that often causes confusion, the Granger causality equation.
Yes, the name itself can be a bit misleading. It's not about causality in the deep philosophical sense.
It's a statistical test, right? To see if past values of one time series variable help predict future values of another.
Exactly. It's about temporal precedence and predictive power. Does knowing the history of variable X improve your forecast of variable Y, beyond just using the history of Y itself?
Developed by Clive Granger, and Robert Ingall's work on co-integration is related in the 1960s.
Yes, specifically for analyzing time series data, trying to clarify these time-ordered relationships in complex economic data.
The basic bivariate test looks like YT plus some YTK plus some XTK plus Mayukh.
Let's decode. T is the value of variable y at time t. We're trying to predict it using its own past values, the lagged y terms y2.
And potentially the past values of another variable x, the lagged x terms xdk.
Right. The Granger causality test then involves statistical tests, like an f-test, to see if those coefficients on the lagged x terms, the x, are statistically significantly different from 0 as a group.
If they are significant.
It suggests that including past values of x does significantly improve the prediction of y. In that case, we say X Granger causes Y.
For example, if past investment, X, Granger causes industrial production.
Why? It means that knowing past investment trends helps you forecast future industrial production, even after accounting for past production trends.
So for you, the researcher, this is useful in macroeconomics, assessing policy effects.
Instrumental. Does interest rate policy Granger cause inflation? Does government spending Granger cause GDP growth? Also used heavily in finance to find lead-lag relationships between asset prices.
Identifying potential sources of economic fluctuations.
Yes, understanding the temporal sequencing of variables.
But huge G caveats here. It's susceptible to spurious regression.
Absolutely. If two variables just happen to share a common underlying trend or are driven by a third unobserved factor, they might appear to Granger cause each other even if there's no real direct link.
So it only identifies predictive causality, not true cause and effect.
Crucially important distinction. Granger causality does not prove X causes Y in a structural or economic sense.
Doesn't account for omitted variables or nonlinear relationships easily.
Correct. It requires very careful interpretation, strong economic theory alongside it, and often more advanced techniques like structural VAR models to get closer to actual causal inference.
Okay, we're nearing the end. Let's talk about the famous Black-Scholes formula.
Or the Black-Scholes-Merton model, technically. A landmark in financial engineering.
Its core idea is providing a theoretical price for European-style options.
Right, options that give you the right, but not the obligation, to buy, call, or sell, put an underlying asset at a specific price, strike price, on a specific date, expiration.
And the formula links things like the current stock price, time remaining, volatility, interest rates.
To the theoretical value of that option. It revolutionized derivatives markets. Before this, option pricing was much more ad hoc, intuitive.
Developed in the 1970s, Nobel Prize-winning work.
Yes, by Fisher Black, Myron Scholes, and Robert Merton. It provided a standardized, mathematically rigorous valuation method.
The formula itself is actually a complex partial differential equation, PDE.
It is. It describes how the option price, V, should change in relation to changes in the underlying stock price, S in time t.
It also incorporates the stock's volatility, how much its price fluctuates, and the risk-free interest rate.
What's fascinating is its mathematical structure resembles the heat equation in physics, shows surprising connections.
So think of it like a sophisticated calculator. You input the current stock price, strike price, time to expiry, volatility estimate, risk-free rate.
And it outputs a theoretically fair price for the option based on the model's assumptions.
For you, the researcher, this model basically democratized options trading.
It did. And it transformed risk management for financial institutions, allowing for much more precise hedging of positions.
Used in corporate finance too, valuations.
Yes, for valuing things like embedded options in corporate securities or in M&A deals. It fundamentally changed how complex financial instruments were understood and traded.
But big assumptions again. Constant volatility.
That's a major one. Real-world volatility changes constantly. It also assumes efficient markets, no transaction costs, no dividends paid during the option's life.
Which are often violated in reality.
Yes, and some critics argue its seeming precision might have contributed to overconfidence and risk-taking, potentially playing a role in events like the 2008 financial crisis by masking underlying model risk.
So continuous refinement and alternative models are always being developed, like stochastic volatility models.
Absolutely. The field is constantly evolving to address its shortcomings and better capture market realities.
And finally, our last equation, or rather concept, chaos theory.
This one embraces complexity and unpredictability, challenging traditional economic models based on equilibrium and stability.
The core idea is that in many nonlinear systems, like perhaps economies or financial markets, tiny changes in initial conditions
Can lead to vastly different, unpredictable outcomes over time. The famous butterfly effect.
Where did this come from? Not economics initially.
No, it emerged from meteorology. Edward Lorenz in the 1960s running weather simulations. He noticed minuscule rounding differences led to wildly divergent forecasts.
And then applied to population dynamics and eventually economics.
Yes, using tools like the logistic map. It fundamentally challenged models assuming predictable, stable paths.
The key example equation often used is the logistic map.
Yeah.
xt plus 1 is rxt, 1xt.
Right. XT could represent a proportion, maybe market share, population fraction. R is a parameter, like an adoption or growth rate.
And depending on the value of R, the system behaves differently.
Exactly. For low R, it settles to a stable point. For higher R, it might oscillate. And for R close to 4, the behavior becomes truly chaotic, seemingly random, unpredictable, yet deterministic.
Let's use that tech example, TechWave versus Future Gizmo. Initial adoption rates differ only in the fourth decimal place.
Say 0.7000 versus 0.7001. If Mac is in the chaotic region, after maybe 40 iterations, their adoption rates, XT, could be wildly different. One year 99%, the other maybe around 80%.
Wow. Extreme sensitivity to initial conditions.
So for you, the researcher, chaos theory highlights the potential for inherent unpredictability in financial markets, economic growth patterns, technological diffusion.
It suggests policymakers maybe need more flexible, adaptive approaches, recognizing feedback loops, interconnectedness.
Precisely. Rather than relying on precise long-term forecasts, which might be impossible in chaotic systems, it encourages humility about our predictive power.
But limitations. The models used are often simplified.
Yes, they often capture the potential for chaos, but might not fully represent the intricate complexity of real economic systems.
And while it highlights unpredictability, it doesn't offer precise forecasts itself.
By its very nature, no. It tells you that long-term prediction might be futile, but not what will happen. It encourages caution and using it alongside other economic theories, not as a standalone predictive tool.
Wow. Okay, we've really covered a lot of ground today.
We certainly have. A journey from the steady growth of compound interest.
All the way to the unpredictable twists and turns of chaos theory.
Each equation, each concept, whether it's guiding an investment or revealing market dynamics, really is a testament to the power of structured thinking in trying to understand our economic world.
And for you, listening, especially if you're embarking on your own research journey, understanding these isn't just about memorizing formulas.
Not at all. It's about developing a critical mind, seeing how economists have grappled with complexity, acknowledging the power and the limitations of each tool.
It's about appreciating that behind policies, behind market trends, there's often an underlying mathematical or conceptual framework shaping it.
Revealing that hidden logic, or at least the logic economists use to try and understand it.
So, as you venture forth in your studies, maybe consider this thought. If even these precise-looking equations have limitations, are constantly being debated, reevaluated,
What does that tell us about the nature of knowledge itself? That it's always evolving, always being refined.
maybe how will your own unique journey, your own research, contribute to that ongoing process of refining our collective understanding of the economic world?
A profound question to ponder.
And once again, we really do encourage you to delve deeper into Professor Panayotis G. Michaelides' original book, 21 Equations That Shaped the World Economy.
It's a truly enriching read, offering much more context and nuance than we could cover here.
The link is right there in our show notes for you. Please do check it out. And don't forget to subscribe to Revise and Resubmit on Spotify and Apple Podcasts. Until next time, keep those minds curious, keep questioning, and keep revising and resubmitting.
রিভাইজ অ্যান্ড রিসাবমিটে স্বাগত। আপনারা শুনছেন আমাদের উইকেন্ড বুক রিভিউ পর্ব। আমি নিকিতা।
আর আমি পাভলভ।
ভাবুন তো, সামান্য কিছু টাকা সময়ের সাথে সাথে কিভাবে বিশাল সম্পদে পরিণত হতে পারে।
কিংবা ধরুন একটা ছোট ঋণ দেখতে দেখতে অনেক বেড়ে গেল।
ঠিক, এই যে শক্তি যা বৃদ্ধিকে এতখানি ত্বরান্বিত করে, এটাই তো চক্রবৃদ্ধির সুদ, তাই না? অর্থনীতির এরকম অনেকগুলো শক্তিশালী আইডিয়া আছে।
একদম। আর এই রকমই কিছু ধারণা নিয়ে প্যানায়োটিস জি মাইকেলাইডস তার 21টি সমীকরণ যা বিশ্ব অর্থনীতিকে আকার দিয়েছে বইটা লিখেছেন।
আমরা আজ ওই বইটারই একটা লার্জ ল্যাঙ্গুয়েজ মডেল বা এলএলএম দিয়ে তৈরি করা সারসংক্ষেপ নিয়ে কথা বলবো।
হ্যাঁ, তবে এটা কিন্তু মূল বইটার বিকল্প নয়, শুধু একটা ধারণা দেওয়ার চেষ্টা আর কি।
অবশ্যই। আর লেখক প্যানায়োটিস জি মাইকেলাইডস, উনি তো খুবই পরিচিত একজন মানুষ, গ্রিসের এনটিইউতে অধ্যাপক।
হ্যাঁ, আর লন্ডন স্কুল অফ ইকোনমিক্স বা এলএসির প্রাক্তন রিসার্চ অ্যাসোসিয়েট, বিশ্বের সেরা 1% অর্থনীতিবিদদের মধ্যে একজন।
তার বইটি খুবই চিন্তাশীলভাবে লেখা।
সেই কারণেই আমরা সবাইকে যারা শুনছেন অনুরোধ করব মূল বইটা সময় করে পড়ার জন্য। লিঙ্কটা শো নোটসে আছে।
বিশেষ করে যারা সবে গবেষণা শুরু করছেন তাদের জন্য এটা খুব কাজের হতে পারে।
তো শুরু করা যাক প্রথম অধ্যায় দিয়ে, চক্রবৃদ্ধি সুদ। এটা এত ফান্ডামেন্টাল কেন?
দেখুন, এটা আসলে সময় আর অর্থের মধ্যে একটা ব্রিজ তৈরি করে। আজকের নেওয়া একটা সিদ্ধান্ত, সঞ্চয় হোক বা ঋণ, ভবিষ্যতে কি চেহারা নেবে
সেটাই সমীকরণ দিয়ে বোঝা যায়। শুধু ব্যক্তিগত টাকা পয়সা নয়, দেশের অর্থনীতি, বিনিয়োগের রিটার্ন, সবকিছুতেই এর প্রভাব।
এর ধারণাটাও তো বেশ পুরনো, তাই না?
হ্যাঁ, ইতিহাস ঘাঁটলে মধ্যযুগীয় ইতালি বা তারও আগে এর চল দেখা যায়। এটা আসলে ভবিষ্যতের দিকে তাকানোর একটা গাণিতিক উপায়।
ভবিষ্যতের দিকে তাকাতে গেলেই তো ডেটা বিশ্লেষণ করতে হয়। এখানে কি নর্মাল ডিস্ট্রিবিউশন কাজে আসে? ওই যে ঘণ্টা আকৃতির গ্রাফটা?
ঠিক ধরেছেন। অর্থনীতির প্রচুর ডেটা, যেমন ধরুন আয়ের বন্টন বা শেয়ার বাজারের রিটার্ন, প্রায় এই নর্মাল ডিস্ট্রিবিউশন মেনে চলে।
এটা সিমেট্রিক্যাল হয়, গড় মানের দুদিকে সমানভাবে ছড়িয়ে থাকে।
একদম। আর এর একটা খুব জরুরি নিয়ম আছে, ওই যে 68, 95, 99.7 রুল, বেশিরভাগ ডেটাই গড়ের কাছাকাছি থাকে।
আচ্ছা, গবেষকদের ডেটা প্যাটার্ন বুঝতে এটা নিশ্চয়ই খুব সাহায্য করে।
অবশ্যই, এটা একটা বেসিক টুল। তবে হ্যাঁ, এর সীমাবদ্ধতাও আছে। বাস্তব দুনিয়া তো সবসময় এত গোছানো হয় না। খুব এক্সট্রিম ঘটনা বা আউটলায়ারগুলো এই মডেলে ঠিকমতো ধরা যায় না।
ডেটা প্যাটার্ন বোঝার পর তো চলকগুলোর মধ্যে সম্পর্ক খোঁজার প্রশ্ন আসে। যেমন ধরুন, পড়াশোনার সাথে আয়ের কি সম্পর্ক? এখানে কি ওএলএস বা সাধারণ ন্যূনতম বর্গ পদ্ধতি ব্যবহার হয়?
ঠিক তাই। ওএলএস বা অর্ডিনারি লিস্ট স্কোয়ারস হলো ডেটা পয়েন্টগুলোর মধ্যে সম্পর্ক বোঝার একটা মৌলিক আর খুব শক্তিশালী পদ্ধতি।
এটা কিভাবে কাজ করে?
ধরুন, আমরা দেখতে চাই কাজের সময় বাড়ালে উৎপাদন কতটা বাড়ে। ওএলএস আমাদের ডেটা পয়েন্টগুলোর মধ্যে দিয়ে এমন একটা সরল রেখা টানতে সাহায্য করে যেটা ওই ডেটার সাথে সবচেয়ে ভালোভাবে ফিট করে।
সবচেয়ে ভালো ফিট
ডেটা পয়েন্টগুলো থেকে ওই রেখার দূরত্বের যে বর্গ, তার সমষ্টিকে মিনিমাইজ করা হয়।
আচ্ছা, আর
আর স্কোয়ার দিয়ে বোঝা যায় মডেলটা ডেটার কতটা ভেরিয়েশন ব্যাখ্যা করতে পারছে। তবে ওএলএস কিছু অনুমিতির ওপর চলে, তাই রেজাল্ট ইন্টারপ্রেট করার সময় একটু সতর্ক থাকতে হয়।
সম্পর্ক বোঝার পর যদি উৎপাদন প্রক্রিয়াটা বুঝতে চাই, চতুর্থ অধ্যায়ে তো কব ডগলাস উৎপাদন ফাংশনের কথা আছে।
হ্যাঁ, এটা একটা ক্লাসিক্যাল মডেল। এটা দেখায় কিভাবে ইনপুট মানে ধরুন শ্রম আর মূলধন মিলে আউটপুট বা পণ্য তৈরি হয়।
এর একটা ফর্মুলা আছে না, y = a গুণ l টু দি পাওয়ার আলফা।
হ্যাঁ, y = a l আলফা k বিটা। এখানে y হলো মোট আউটপুট, l শ্রম, k মূলধন।
আর এটা কি?
এ হলো টেকনোলজি বা টোটাল ফ্যাক্টর প্রোডাক্টিভিটি, টিএফপি। এটাকে অর্থনীতির সিক্রেট সসও বলা হয়। মানে একই শ্রম মূলধন দিয়েও এই এ বাড়লে উৎপাদন বাড়ে।
এটা তাহলে অর্থনৈতিক প্রবৃদ্ধির উৎস বুঝতে সাহায্য করে।
ঠিক। তবে এর একটা সমালোচনা হলো ধ্রুবক রিটার্ন টু স্কেল ধরে নেওয়া। মানে ইনপুট দ্বিগুণ করলে আউটপুটও ঠিক দ্বিগুণ হবে, যা সবসময় সত্যি নাও হতে পারে।
আচ্ছা, উৎপাদন থেকে এবার একটু দীর্ঘমেয়াদী বৃদ্ধির দিকে যাই। ষোড়শ অধ্যায়, সোলো গ্রোথ মডেল।
হ্যাঁ, রবার্ট সলোর নোবেল বিজয়ী কাজ। এটা দেখায় কিভাবে দীর্ঘমেয়াদে একটা দেশের অর্থনীতি বাড়ে। মূলত দুটো জিনিস দিয়ে, মূলধন জমানো মানে বিনিয়োগ আর টেকনোলজির উন্নতি।
এতে স্টেডি স্টেট বা স্থিতিশীল অবস্থার একটা ধারণা আছে না?
হ্যাঁ, মানে এমন একটা অবস্থা যেখানে মাথাপিছু মূলধন আর উৎপাদন স্থির হয়ে যায়, যদি না টেকনোলজির উন্নতি হয়। সময়ের সাথে পরিবর্তন দেখাতে এটা ডিফারেন্সিয়াল ইকুয়েশন ব্যবহার করে।
কিন্তু এর সীমাবদ্ধতাও আছে।
আছে, যেমন টেকনোলজির উন্নতিকে এটা মডেলের ভেতরের কোনো কারণ হিসেবে দেখে না, মানে এক্সোজেনাস ধরে নেয়। আর পরিবেশের ওপর প্রভাব তো পুরোপুরি বাদ।
আর একদম শেষে একবিংশ অধ্যায়, ক্যাওস থিওরি। অর্থনীতি তো বেশ জটিল, এই থিওরি কি সেই জটিলতাকেই ব্যাখ্যা করে?
অনেকটা তাই। অনেক মডেল অর্থনীতিকে বেশ স্থিতিশীল বা ইকুইলিব্রিয়ামে থাকা সিস্টেম হিসেবে দেখে, কিন্তু ক্যাওস থিওরি বলছে সিস্টেমগুলো আসলে খুব জটিল, নন লিনিয়ার। মানে হলো শুরুর অবস্থায় খুব সামান্য পরিবর্তন হলেও ভবিষ্যতে তার ফল অনেক বড় হতে পারে। এটাই তো বিখ্যাত বাটারফ্লাই এফেক্ট।
হ্যাঁ, শুনেছি।
ধরুন একটা নতুন টেকনোলজি বাজারে এলো, শুরুতে হয়তো অল্প মানুষ ব্যবহার করছে, কিন্তু হঠাৎ করে সেটার ব্যবহার বেড়ে গেল। এই ধরনের ঘটনা লজিস্টিক ম্যাপ দিয়ে মডেল করা যায়।
নীতি নির্ধারকদের জন্য এর মানে কি দাঁড়ায়?
এর মানে হলো ভবিষ্যৎ সবসময় প্রেডিক্ট করা যাবে না, তাই পলিসি হতে হবে ফ্লেক্সিবল, অ্যাডাপ্টিভ। একটা সামগ্রিক দৃষ্টি রাখতে হবে।
অসাধারণ। এই সমীকরণগুলো আসলে শুধু অঙ্ক নয়, এগুলো অর্থনীতির ভেতরের কলকবজা বোঝার চাবি।
ঠিক। প্যানায়োটিস মাইকেলাইডিসের মতো একজন শীর্ষ অর্থনীতিবিদ যেভাবে এই জটিল বিষয়গুলো সহজ করে তুলে ধরেছেন, তা সত্যিই দারুণ।
আর যারা এতক্ষণ আমাদের কথা শুনলেন, তাদের জন্য একটা চিন্তার খোরাক থাকলো।
বলুন।
এই সমীকরণগুলোর পেছনের যুক্তিগুলো বুঝতে পারলে প্রতিদিনের অর্থনীতির খবর পড়া বা নিজের টাকা পয়সা সিদ্ধান্ত নেওয়ার ক্ষেত্রে আমাদের দৃষ্টিভঙ্গিটা কিভাবে বদলাতে পারে।
গভীর প্রশ্ন। আবারও বলছি, আমাদেরই আলোচনা কিন্তু মূল বইটার গভীরতার কাছে কিচ্ছু না।
একদম। তাই অনুরোধ করব, আসল বইটা অবশ্যই পড়ুন। ধন্যবাদ।
ধন্যবাদ।
नमस्कार।
रिवाइज एंड रीसबमिट में आपका स्वागत है। मैं हूं पावलोव।
और मैं हूं निकिता।
सोचिए, एक छोटी सी बचत, मान लीजिए 100 रुपए, अगर हर साल 10% बढ़े तो 50 साल में कितनी हो जाएगी? करीब 11,700 रुपए। ये कोई जादू तो है नहीं, है ना? ये गणित का कमाल है जिसे चक्रवृद्धि ब्याज कहते हैं, और यही वो ताकत है जो हमारी अर्थव्यवस्था के पहियों को घुमाती है। असल में आज हम बात कर रहे हैं पनायोटिस जी माइकेलाइडिस की किताब की 21 इक्वेशंस दैट शेप्ड द वर्ल्ड इकोनॉमी। पर एक बात साफ कर दें, ये चर्चा उस किताब का सिर्फ एक LLM सहायता प्राप्त सारांश है।
हाँ, और ये भी बताना जरूरी है कि प्रोफेसर माइकेलाइडिस कौन है। वो NTUA ग्रीस में गणित और भौतिक विज्ञान के फुल प्रोफेसर हैं और पहले लंदन स्कूल ऑफ इकोनॉमिक्स माने LSE में रिसर्च एसोसिएट भी रह चुकी हैं। दुनिया के टॉप 1% अर्थशास्त्रियों में उनका नाम आता है, जिनकी रिसर्च खूब पढ़ी जाती है।
बिल्कुल, इसलिए हम सबसे गुजारिश करते हैं कि ये बेहतरीन मूल किताब जरूर पढ़ें। चाहे आप इस चैनल को सब्सक्राइब करें या ना करें, समय निकाल कर इसे पढ़िएगा जरूर। लिंक हमने शो नोट्स में डाल दिया है।
जी, ये किताब असल में जटिल आर्थिक विचारों को थोड़ा आसान बनाने की कोशिश है, खासकर उनके लिए जो अकादमिक रिसर्च की दुनिया में बस कदम रख ही रहे हैं। प्रोफेसर माइकलाइडीज ने मुश्किल कॉन्सेप्ट्स को काफ़ी सरल भाषा में समझाया है। तो चलिए कुछ खास समीकरणों और उनके मतलब को समझने की कोशिश करते हैं।
हाँ, शुरू करते हैं उसी चक्रवृद्धि ब्याज से। ये तो समझ आता है कि इससे पैसा बढ़ता है, पर ये रिसर्च करने वालों के लिए इतना अहम क्यों है? क्या खासियत है इसमें?
देखिए, ये सिर्फ पैसों के बढ़ने का हिसाब नहीं है, ये उससे कहीं ज्यादा है। ये दिखाता है कि समय अपने आप में कितनी बड़ी ताकत है। रिसर्च में चाहे आप आर्थिक विकास मॉडल कर रहे हों या किसी पॉलिसी का लंबा असर देख रहे हों, ये कॉन्सेप्ट बार बार सामने आएगा। ये समझने में मदद करता है कि एक छोटी शुरुआत, एक छोटा सा अंतर भी लंबे समय में कितना बड़ा फर्क पैदा कर सकता है। यही तो वित्त और निवेश का बिल्कुल आधार है।
अच्छा, समय का जादू, ठीक है। लेकिन दुनिया में सब कुछ एक सीधी रेखा में तो नहीं बढ़ता ना, उतार चढ़ाव तो होते ही हैं। यहाँ शायद वो सामान्य वितरण या बेल कर्व काम आता है। ये हमें क्या बताता है?
बिल्कुल सही, ये बेल कर्व, हाँ, असल में डेटा में एक पैटर्न दिखाता है। आप सोचिए, जैसे लोगों की लंबाई, ज्यादातर लोग औसत लंबाई के आसपास होते हैं, सही। बहुत लंबे या बहुत छोटे लोग कम ही मिलते हैं। रिसर्च में ये टूल हमें किसी भी चीज के फैलाव को समझने में मदद करता है, जैसे आमदनी हो या परीक्षा के अंक या फिर स्टॉक मार्केट का रिटर्न। ये दिखाता है कि ज्यादातर नतीजे औसत के पास क्यों होते हैं और जो किनारे वाले नतीजे होते हैं, जिन्हें आउटलायर्स कहते हैं, वो कितने कम होते हैं। रिस्क समझने के लिए तो ये बहुत ही जरूरी है।
ओके, ठीक है। अब मान लीजिए हमारे पास बहुत सारा डेटा है, जैसे किसी की पढ़ाई और उसकी कमाई का डेटा। अब हमें यह पता लगाना है कि इनमें कोई रिश्ता है भी या नहीं, और है तो कैसा। क्या यहाँ पर सामान्य न्यूनतम वर्ग यानी OLS मदद करता है? ये सबसे अच्छी फिट होने वाली रेखा, ये क्या भला है आखिर?
हाँ, OLS समझिए, ये एक तरह का जासूस है जो डेटा पॉइंट्स के बीच छिपे रिश्ते को ढूंढ निकालता है। कल्पना कीजिए कि बहुत सारे बिखरे हुए बिंदु हैं। OLS उन बिंदुओं के बीच से एक ऐसी सीधी रेखा खींचने की कोशिश करता है जो औसतन सबके सबसे करीब हो। रिसर्च की दुनिया में जो लोग नए हैं, उनके लिए ये एक बुनियादी मगर बहुत शक्तिशाली औजार है। ये हमें अंदाजा लगाने में मदद करता है कि अगर एक चीज बदलती है, जैसे शिक्षा के साल, तो दूसरी चीज जैसे आमदनी, उस पर औसतन कितना असर पड़ेगा। असल दुनिया के डेटा पर जो रिसर्च होती है ना, जिसे एम्पिरिकल रिसर्च कहते हैं, वो बहुत हद तक इसी पर टिकी है।
अच्छा, यानी रिश्तों को नापने का एक तरीका। अब बात करते हैं कि अर्थव्यवस्था में चीजें बनती कैसे हैं। सामान, सेवाएं, इसमें उत्पादन फलन या प्रोडक्शन फंक्शन का क्या रोल है? ये इनपुट और आउटपुट की कहानी क्या है?
उत्पादन फलन को आप एक तरह की रेसिपी समझ सकती हैं। ये बताता है कि आप कितनी मेहनत यानी श्रम और कितनी मशीनें यानी पूंजी, इन्हें मिलाकर कितना सामान या सेवाएं मतलब आउटपुट बना सकते हैं। ये माइक्रो इकोनॉमिक्स और मैक्रो इकोनॉमिक्स दोनों की जान है। रिसर्च में ये समझने में मदद करता है कि कोई कंपनी या पूरी अर्थव्यवस्था कितनी कुशल है, या फिर टेक्नोलॉजी में तरक्की, जिसे हम TFP या टोटल फैक्टर प्रोडक्टिविटी कहते हैं, वो कैसे उत्पादन बढ़ाती है और उससे आर्थिक विकास कैसे होता है।
और आर्थिक विकास की बात चलिए तो लंबे समय के विकास को समझने के लिए सोलो ग्रोथ मॉडल भी है ना? ये पूंजी, जनसंख्या और टेक्नोलॉजी को कैसे जोड़ता है?
हाँ, सोलो मॉडल लंबे समय में देशों की तरक्की की कहानी कहता है। ये मैक्रो इकोनॉमिक्स का एक क्लासिक मॉडल है। ये दिखाता है कि सिर्फ ज्यादा मशीनें या पूंजी जमा करने से लगातार तेज ग्रोथ नहीं मिलती, वो एक सीमा तक ही काम करता है। असली और टिकाऊ तरक्की आती है बेहतर टेक्नोलॉजी और कुशलता से, मतलब TFP से। ये मॉडल रिसर्चर्स को ये समझने में मदद करता है कि नीतियाँ जैसे बचत बढ़ाना, आबादी कंट्रोल करना या नई टेक्नोलॉजी अपनाना, इनका देश की ग्रोथ पर लंबे समय में क्या असर पड़ेगा।
दिलचस्प। ये तो हुई बड़ी तस्वीर की बात, मैक्रो लेवल की। पर अर्थव्यवस्था तो लोगों के फैसलों से भी चलती है, जहां हर कोई अपने फायदे का सोच रहा होता है, अक्सर दूसरों के कामों को ध्यान में रखकर। यहाँ नैश इक्विलिब्रियम कैसे फिट होता है? ये प्रिजनर डिलेमा जैसी क्या चीज है?
नैश इक्विलिब्रियम, हाँ, ये गेम थियोरी का एक बहुत ही अहम कॉन्सेप्ट है। ये उस स्थिति को कहते हैं जहाँ कई लोग एक दूसरे के फैसलों को ध्यान में रखकर अपना अपना फैसला लेते हैं, और ऐसी स्थिति बन जाती है जहाँ कोई भी अकेले अपना फैसला बदलकर ज्यादा फायदा नहीं उठा सकता, बशर्ते
कि बाकी लोग अपना फैसला ना बदले। सोचिए जैसे ट्रैफिक जैम है, कोई अकेले लेन बदलकर शायद ही फायदा उठा पाए, है ना। रिसर्च में ये कंपनियों के बीच कंपटीशन, देशों के बीच समझौते या रोजमर्रा के बातचीत ऐसी स्थितियों को समझने में मदद करता है जहां आपका नतीजा दूसरों के एक्शन पर भी निर्भर करता है।
वाकई ये समीकरण दुनिया को, खासकर आर्थिक दुनिया को देखने का एक बिल्कुल नया नजरिया देते हैं। जैसा प्रोफेसर माइकलाइडिस कहते हैं, ये किताब हर किसी के लिए एक दोस्ताना साथी जैसी है, चाहे कोई पहली बार अर्थशास्त्र पढ़ रहा हो या अपने ज्ञान को और बढ़ाना चाहता हो।
और एक मजे की बात बताऊं, लेखक ने इस किताब को लिखने में आर्टिफिशियल इंटेलिजेंस यानी AI की भी मदद ली है, ताकि विश्लेषण सटीक हो और भाषा भी एकदम साफ और स्पष्ट हो। ये भी दिखाता है कि टेक्नोलॉजी कैसे अकादमिक काम को भी बेहतर बना सकती है।
हाँ, ये तो है। ये गणितीय समीकरण हमें इस जटिल आर्थिक दुनिया को समझने में मदद तो करते हैं, पर एक सवाल मेरे मन में आता है, क्या ये मॉडल और समीकरण इंसान के बर्ताव की पूरी गहराई को पकड़ सकते हैं, उसकी भावनाओं, उसकी सोच की अनिश्चितता को?
ये बहुत गहरा सवाल है और शायद इसका कोई आसान जवाब नहीं है। इस पर सोचते रहना चाहिए, और इन विचारों में अगर और गहराई से उतरना है तो पेनायोटिस जी माइकलाइडिस की मूल पुस्तक 21 इक्वेशंस दैट शेप्ड द वर्ल्ड इकोनॉमी, इसे जरूर पढ़ें। लिंक आपको शो नोट्स में मिल जाएगा।